In one of the fastest shifts in history, family offices are loading up on stocks and they're souring on private equity. Robert Frank is here. He's got some new data for us as well. Robert.
Good morning, David. Good to see you guys. Well, family offices increasing their allocation to stocks to the highest level in years. The private investment firms for wealthy families, typically worth $100 billion or more, planning to boost their stocks to 29% of their portfolios, up from 26%. Now, that was last year. American family offices even more bullish, with their stocks at 32%. All that according to a new report from UBS. Now, at the same time, they are trimming their private equity holdings, going to 35% from 27%. This marks a sweeping reversal for family offices, which, of course, had been moving to private markets away from public markets before this. Now, family offices also staying very close to home. They have 86% of their investments in the U.S. That compares to a global average of 53% of overseas investors invested in the U.S.
I think the U.S. markets have performed quite a bit better than other markets around the world. I'm sure that's part of the reason here. But I think really it's the family offices they're staying close to what they understand, what they know.
Now, to see all of the investment portfolios of today's family offices and where they're putting their money, you can get the Inside Wealth newsletter at cnbc.com/InsideWealth or scan the QR code cnbc.com/Inside Wealth.
So what's the issue with private equity? I mean, I can imagine a number, including, of course, number one being fees. But what is souring them to the extent we're aware?
Exits. David, as you've reported well, there's no IPOs, there's no M&A, so you can't get money out of your private equity fund. So all that money that typically got recycled or added during fundraisers is not going back in, coupled with the fact that in public markets, the number one investment theme for family offices right now is AI. Now, unless you're lucky enough to get into OpenAI or these fundraising rounds for these big AI companies, it's all about scale. So to play AI, you really have to do it through the public market. So it's that private equity is less attractive and public markets are more attractive because that's where they can get into the AI trade.
Makes sense.
That's a good point. And at a later date, we'll talk about how higher ed is changing some of their allocations, too.
Absolutely. And they're selling a lot of their private equity because they need cash.
Right. Yeah, these secondary funds are benefiting as a result of providing that liquidity.
That's right.